If your income stays below $25,000 as a single retiree, or $32,000 if you are married filing jointly, the federal government takes zero of your Social Security. Cross those lines and up to 85% of your benefit becomes taxable income. There is a move, a specific filing decision, that pulls thousands of retirees back under that line every single year. Almost none of them know about it. I want to show you what it is. And I want to show you why the IRS has made it so easy to miss. My name is William Hayes. For more than 20 years, I have prepared returns for retirees and reviewed the IRS rules for the over 65 filer. I have sat across the kitchen table from people who paid taxes on their Social Security for a decade and did not have to. That never gets easier to say. I am not a television anchor. I do not have a studio. What I have is 20 years of tax returns, a lot of frustration with how poorly these rules get communicated, and a commitment to laying this out in plain English so you can walk into your tax preparer's office or your kitchen and know exactly what questions to ask. This video is going to take a few minutes. I am asking you to stay with me because the details here matter more than the headline. The headline is the hook. The details are what actually put money back in your pocket. If you have not subscribed yet, please do that now. I put out a new video every week on Social Security, Medicare, IRS rules, and senior tax law. No fluff, no selling, just the rules. Before we get into the mechanics, I want to clear out two myths that I hear constantly. Both of them cost people money. Myth number 1, Social Security is never taxed. This one comes from people who retired in the 1970s or early 1980s, when it was true. Congress changed that in 1983. Since 1984, Social Security benefits have been potentially taxable at the federal level. I say potentially because it depends entirely on your income. But the blanket belief that Social Security is tax-free, that has not been accurate for over 40 years. I still hear it at the library. I still hear it at church. It is wrong. Myth number 2. There is nothing I can do about it. This one is more dangerous because it causes people to stop looking. They get their tax bill, they see their Social Security is taxed, they shrug, and they move on. That shrug costs some of them $2,000 a year. $4,000. Sometimes more. The truth is there are legal, documented strategies that can reduce or eliminate the federal tax on your Social Security benefits. They are in the IRS code. They are not loopholes. They are not tricks. They are the rules, applied correctly. And the reason most people do not use them is that nobody sat down and explained them clearly. That is what myth number 2 actually is. Not a fact about taxes, but a fact about information. Or the lack of it. Now let me give you the real structure of how this works. The federal government does not look at your Social Security check in isolation to decide whether to tax it. It looks at something called your provisional income. You may also hear it called combined income. The formula is straightforward. Take your adjusted gross income. That is your income from pensions, IRA withdrawals, wages, interest, dividends, capital gains, and so on. Then add any tax-exempt interest you received, and then add 50% of your Social Security benefit for the year. That total is your provisional income. Here is what the IRS does with that number, according to IRS Publication 915. If your provisional income is below $25,000 and you file as a single person, or below $32,000 if you are married filing jointly, none of your Social Security is federally taxed. 0. That is the floor. If your provisional income is between $25,000 and $34,000 as a single filer, up to 50% of your Social Security can become taxable. Not 50% of your check is gone. 50% of your benefit becomes included in your taxable income, and then your regular bracket applies to it. Above $34,000 as a single filer, or above $44,000 married filing jointly, up to 85% of your benefit is included in taxable income. 85%. That is the number that surprises people. If you receive $24,000 a year in Social Security and your provisional income is over $34,000, up to $20, $400 of your Social Security could be included in your taxable income. At a 22% federal tax rate, that is roughly $488 a year in additional federal taxes on income that many people believe is tax-free. Now here is the detail that almost nobody mentions, and it is the one that makes me quietly furious every filing season. These thresholds, $25,000, $32,000, $34,000, $44,000, have never been adjusted for inflation, not once. The $25,000 and $32,000 limits were set by Congress in 1983 and took effect in 1984. The $34,000 and $44,000 limits were added by the Omnibus Budget Reconciliation Act of 1993. According to research cited by the Social Security Administration's own policy office, the percentage of Social Security recipients who owe federal taxes on their benefits rose from about 12% in 1984 to well over half of all beneficiaries today. The reason is not that retirees got richer. The reason is that these thresholds sat still while inflation moved everyone forward, never indexed. So the situation you are in, if you are paying taxes on your Social Security, may have nothing to do with whether you are genuinely well off. It may simply be that the government set a line in 1984 and never moved it, and your cost of living caught up to it 30 years ago. That is the frustrating part. Now here is the useful part. The most powerful single lever most retirees have to reduce or eliminate the tax on their Social Security is the Qualified Charitable Distribution, AQCD. And most people who qualify for it have never heard of it. Here is how it works. If you are age 70 and a half or older, and you have a traditional IRA, you are allowed to instruct your IRA custodian, your brokerage, your bank, to transfer money directly to a qualified charity. In 2026, the annual limit on that transfer is $108,000, according to IRS publication 590B. That money goes from the IRA straight to the charity. You never touch it. Here is why that matters for Social Security taxes. When you take a normal IRA withdrawal, it becomes part of your adjusted gross income. That raises your provisional income, which can push more of your Social Security into the taxable column. But a QCD never touches your AGI. It is excluded from income entirely. The IRA goes down. Your taxable income does not go up, and your provisional income stays lower, sometimes low enough to drop you under the threshold entirely. The form that makes this happen is not a complicated document. You contact your IRA custodian and request a direct distribution to a qualifying charity. They handle the transfer. On your tax return, the QCD gets reported on your Form 1040, and the distribution is marked as non-taxable. The QCD satisfies your required minimum distribution for the year, your RMD, without adding income. That is the move. That is the one almost no one files. There are other levers too, and I want to mention them because the right one for you depends on your situation. Roth conversions. If you have a year when your income is unusually low, maybe before Social Security starts, maybe between jobs, you can convert traditional IRA money to a Roth IRA, pay tax on it at a lower rate now, and then pull from the Roth later with zero impact on your provisional income. Roth withdrawals do not count toward the formula. RMD timing. You cannot avoid required minimum distributions once you hit the applicable age, currently 73 under current law. But how you manage what you pull beyond the minimum and when affects your provisional income every year. Form W-4V. This is the voluntary withholding request. It does not reduce the amount of Social Security that is taxable. But if you owe taxes on your benefits, you can use Form W-4 versus, that is, W-4V, to have the Social Security Administration withhold a flat percentage from your monthly check, 7%, 10%, 12%, or 22%. This prevents a large lump sum payment at filing time and helps you stay current. It is simple, one page, and mailed directly to your local Social Security office. Most people do not know it exists. Confirm any of these strategies with a tax professional before acting. The interaction between IRA withdrawals, Social Security income, RMDs, and QCDs is real, documented, and legal, but your specific numbers determine which lever helps most. Now I want to walk you through a real-world example. The names and identifying details are composite to protect privacy. This is not a single specific client, but the income figures and the tax math are drawn from actual returns I have reviewed. Her name for this video is Eleanor. She is 74 years old. She lives in Columbus, Ohio. She is widowed, files as a single taxpayer. She receives $22,800 per year in Social Security. She also receives $1,100 per month from a small pension, $13,200 per year. Her traditional IRA had a required minimum distribution of $9,400 for the year. Let us run her provisional income before she does anything. Her adjusted gross income, $13,200 pension plus $9,400 RMD equals $22,600. She has no tax-exempt interest. Half of her Social Security is $11,400. Provisional income, $22,600 plus $11,400 equals $34,000. She is sitting exactly at the upper threshold for the 50% tier. Depending on the precise calculation, up to 50% of her $22,800 in Social Security, up to $11,400, could be included in her taxable income. At a 12% federal tax bracket, that is roughly $1,368 in additional federal tax on her Social Security. Eleanor has been donating $4,500 per year to her church and a local food bank. She has been writing checks from her checking account, then itemizing, or, more likely, taking the standard deduction because her total deductions did not exceed the threshold. Her tax preparer that year suggested she make those donations as a qualified charitable distribution instead. Here is what changed. She instructed her IRA custodian to transfer $4,500 directly to her church and the food bank. That $4,500 was removed from her RMD calculation. Her remaining RMD dropped to $4,900, and the $4,500 QCD was excluded from her AGI entirely. New AGI, $13,200 plus $4,900 equals $18,100. New provisional income, $18,100 plus $11,400 equals $29,500. She is now in the 50% tier, but at $29,500 of provisional income versus $34,000, the taxable portion of her Social Security dropped to roughly $2,250. At 12%, that is $270 in federal tax on her Social Security, down from $1,368. She saved nearly $1,100 in federal taxes just by routing her charitable giving through her IRA instead of her checking account. She still gave to her church. She still gave to the food bank. She gave the same amount. The only thing that changed was the paperwork. That is not a loophole. That is reading the tax code and using what is in it. I want to be honest with you about one thing. Eleanor's situation was favorable for a QCD because her charitable giving was already close to the dollar amount she needed to move her provisional income. Not everyone has that alignment, but the principle holds. Reducing your AGI by keeping IRA distributions out of it, however you do it legally, is the primary mechanism for pulling your provisional income under the threshold. Now I want to talk about what happens if you have been overpaying for years and did not know it. This is where people get either very relieved or very frustrated, sometimes both. The IRS allows you to file an amended return using Form 1040X. 1040, the letter X. You have 3 years from the original filing deadline to go back and correct a return. That means if you overpaid taxes on your Social Security income in 2023, 2024, or 2025 because you were not using available strategies or because a deduction was missed, you may still be able to file an amended return and claim a refund. 3 years. That is the window. Not forever, but not nothing. The most common scenario I see, a retiree who was eligible to do a QCD but did not know about it, took a full RMD as taxable income, paid tax on their Social Security benefits as a result, and never revisited the return. If they are within 3 years, there may be a correction available, not from the QCD itself, since that is a forward-looking strategy, but from other missed deductions or calculation errors. What I am describing is the look-back review. You go back through your last 3 years of returns, and you ask, was my provisional income calculated correctly? Did I include income that should not have been there? Did I miss any deductions that would have reduced my AGI? This is not a fishing expedition. You are looking for specific things: unreported deductions, IRA contribution errors, misclassified income, or income that was counted twice. These errors are more common than people think, especially on returns prepared quickly or with software that did not ask the right questions. If you find something, Form 1040X is how you correct it. You can file it yourself or have a tax professional file it for you. You attach the corrected Form 1040 and an explanation of what changed. The IRS processes amended returns, and, if a refund is due, sends a check or applies the credit to a future year if you prefer. One important note: if you used a tax preparer and believe they made an error, do not assume they will catch it on their own. You need to bring it to their attention. Preparers are not automatically reviewing prior year returns for errors unless you ask. Be the one who asks. The 3-year window moves forward every April. If you have not reviewed your last 3 years, this week is not too early to start. Here is what I want you to do in the next 7 days. Not someday, this week. Step 1. Calculate your provisional income. Take last year's tax return, find your adjusted gross income, add any tax-exempt interest, and add 50% of the Social Security you received. That number tells you where you stand relative to the thresholds. Write it down. Knowing your number is the first step. Step 2. If you are over 65, charitably inclined, and you have a traditional IRA, ask your tax preparer this one question: should I be doing a qualified charitable distribution this year? That question alone, asked to the right person, has saved retirees thousands of dollars. You do not have to understand every detail of a QCD before you ask. Just ask. Gov. And choose a withholding percentage: 7, 10, 12, or 22%. Mail it to your local Social Security office. This will not reduce what you owe, but it smooths out the payment and keeps you out of underpayment penalty territory. Step 4. If you have not had a professional review your last 3 years of returns, consider scheduling one. You are looking for amended return opportunities within the 3-year window. Many local CPAs and enrolled agents will do a prior year review for a flat fee. You can also use the free tax counseling for the Elderly Program, TCE, or the AARP Tax Aid Program, which offers free preparation and review for seniors. .org/money/taxes/AARP Tax Aid. Step 5. If anything in this video did not make sense, or you want to go deeper on one piece of it, the QCD rules, the Roth conversion strategy, the W-4 verses, write it in the comments. I read them. I will answer where I can, and I will use your questions to plan future videos. This is general education, not personal legal, tax, or financial advice. These rules really do vary by state and by income. Always confirm your own situation with your county, your state SHIP office, the IRS, or a qualified professional before you act. Being legally entitled and actually having the money are two different things. The only bridge between them is the form, and the agencies are not going to build it for you. So we will. If this helped you, share it with someone you know who is on a fixed income. They deserve to know about this too. Next week, I am covering the new senior deduction, the one that went into effect for 2025 returns, that makes Social Security income effectively tax-free for millions of Americans over 65. It is a separate rule from everything we talked about today, and it is one of the biggest changes for senior filers in decades. I will walk through exactly who qualifies and how to claim it. Do not miss it.